Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Welcome to the Going Long podcast. We're back once again to continue to help to educate you so that you feel comfortable as well as confident investing beyond your backyard. And I'm your host, Billy Keels. You know what? If you're a 6-figure salary earner looking to learn more about making a real connection to cash flow, then guess what? Today is the conversation that you're going to want to listen to the absolute very last word, I promise, because today's guest not only has an extremely strong economic background and strong approach to data analysis that gives him a very unique perspective in out-of-state, or we're going to call it long distance investing today. He also has worked across multiple asset teams in several different locations, spanning the United States as well as Canada. He also is the best-selling author of the book called Raising Capital for Real Estate: How to Attract Investors, Establish Credibility, and Fund Deals. He also is a member of the Forge Real Estate Council. He's the managing principal at ASIM Capital, and he is the host of the extremely popular podcast, Cashflow Connections Real Estate Podcast. It gives me great pleasure to welcome to today's show, Hunter Thompson. Welcome to the show, Hunter.
Hey, thanks again for having me on.
Hey, this is really, I'm really looking forward to sharing another conversation with you, this time on the other side of the microphone. So listen, Hunter, you know, we have a certain format that we like to follow here, and like to really start off with helping our Going Long audience understand, where exactly are you based in the United States?
So I'm in Los Angeles, California, sunny SoCal. And I know this has been kind of a crazy year for SoCal residents, as it has been for people all over the world. But, you know, I'm sticking around. I'd rather be in LA than pretty much anywhere else in the world. And so I'm going to stay here and do my thing.
All right. Fantastic. Love that. SoCal, out in Los Angeles area. So speaking of that, because you're already starting on the positive side of things, help us understand, what's the most positive thing that has happened to you in the last 24 hours, Hunter?
Oh boy. 24 hours sounds like a short time period, but 2020, you know, I'm kind of embarrassed to say it. I have revolutionized my business in 2020 and my wife's business as well. She revolutionized her business, but I'd say that tapping into the world of coaching is something both on the paying for and the being paid side of things has been just an incredible help for me. And over the last 24 hours, I really continue to hone in on both sides of that. I think that, you know, I'll expand on that quickly. I started my career in the wake of the Great Recession, and it was in the face of a lot of people who had paid $50,000 or $100,000 to learn how to fix and flip properties. And they were pretty much taught by people who had never fixed or flipped a property. And so I was always really skeptical of that industry, but I had a very positive experience paying, you know, $20,000 for coaching that totally changed my business probably 4 years ago. And I realized, okay, I can actually probably help people too in the world of capital raising, and built out a coaching platform, mentorship platform. And sure, it's like financially cool or whatever, but what's far more compelling and far more fulfilling is seeing those students just take off like rocket ships. And over the last 24 hours, I've really continued to just recognize I really like helping people through that kind of mechanism. And it took me about a decade to figure it out, but there you go.
Fantastic. So being able to go out, make an impact, coaching, helping to actually see success through others is something that's fantastic. And being able to have that reflection over the last 24 hours is something that's phenomenal. So listen, Hunter, I gave a really high level of some of the things that you've been able to accomplish, some of the ways that you are making an impact, and some of the areas that you're involved. But I would love for you to share with us, give us a little bit more about your backstory, please.
So happy to do it. So like I mentioned, I really saw a great opportunity in the United States in the Great recession and the wake thereafter. First, I started looking at stock market investments that I thought were going to perform outside of 2008, 2009, 10, et cetera, and started investing based on typical value type of investing strategies and saw success as most people did in 2008, but hit a big hurdle in 2010 when the European debt crisis happened. Now, for most US investors, this is something that isn't talked about enough. I know that you are very familiar with this, and Spain and Italy and Greece simultaneously had this incredible contraction and really a freezing of the capital markets. And it created massive volatility, not only in Europe, but also in the United States. And so this was a wake-up call for me, because all the studying I had done, all the books of Warren Buffett and Charlie Munger that I had read, did not prepare me for the Greece bond yields to be playing a central role in my entire investment thesis. And so I tried to find out a way to mitigate that risk and to find uncorrelated assets that not only perform and provide cash flow, but we're able to do so with a high degree of predictability during all stages of the economic cycle. And I was open to anything, but it was quickly led to real estate. And I have invested in some non-real estate assets, but the central theme is what products are inversely correlated with the overall economy. The mobile home park business, the self-storage business, the ATM business, which is something that we've done recently, and multifamily apartments, especially C-class and B-class. Basically, I'm willing to give up the upside of some of those more cyclical assets like hotels, for example, or development strategies in exchange for the predictability of outcome. So that's a little bit about my background.
I love that. And so you really looking about the predictability of outcome, the outcome, and that predictability is one of the things that we're going to come back to. And, you just made me think about, there was I've been just wrapping up a book, Fed Up, and they go in a lot into the European debt crisis and do a lot of reflecting on that. And so it's great to also hear you understand that is a central theme that happened during the Great Recession. And you have allowed that to give you a real focus and moving forward. So I want to pick your brain on something. This is, I know, a theme that you think a lot about. Is this whole concept of being an active versus a passive investor? Kind of share your philosophy with us, please.
Sure. So I think going back to, a decade ago, this conversation was only taking place in ultra high net worth areas. And I, to a large degree, uncovered it by chance. And part of that chance was the market had been completely decimated. I moved to California unrelated to the market dynamics, but because California in particular had been so decimated, only the strong were surviving. And so when I went to build my real estate network, I was very fortunate because I was rubbing shoulders with some very savvy, sophisticated, influential investors, all of which who focused their portfolios on syndications. So 2010, 2011, this is before the Jobs Act. The only way that you could actually even get access to private placement deals, like the ones we're going to talk about, where you're a passive investor, was you had to have the network, mostly in person. There wasn't really an online community that was talking about these deals. Now, when 2012 happened, the Jobs Act was started to be ratified, and you could publicly or generally solicit investors, and that changed a lot. But I was well positioned for that change because I had uncovered the route of passive investing. What that really refers to is that when you own real estate, it's typically thought of as you own the asset. You may even hire a property manager, but if something goes wrong at the property level, the manager will call you, the owner of the property. A true passive investment is where you identify an operator who is best in class in their particular niche. They're the ones, the relationships with the brokers, they interface with the lenders, they make the property specific decisions. You have an extra layer between you and the asset. So if something goes wrong at the property level, the manager may call the operator, but the operator doesn't call you. All they do is accept your passive investment and then issue you a quarterly report. And I found that to be very compelling because the way that I have achieved that predictability of outcome is through diversification across all the asset classes that I mentioned, and we can talk about more. But I'm a huge proponent of the passive approach, but I've actually built a career around passive investing because I've built out a very robust due diligence process, the likes of which, even if you are very savvy, it's hard to complete because of the economics. If you're investing $100,000, you can't spend $100,000 on due diligence. You can't fly around the country looking at multiple assets across multiple states. But I think it's prudent to do so as an investor. So what my firm does, ASIM Capital, we pull investors together, conduct a lot of that due diligence on their behalf, and then I invest alongside them. And we make the economics extremely compelling, sometimes just getting even more favorable terms because we're pulling such a large amount of investors together.
Okay. So by being able to pull investors together, being able to have that very clear path of looking at both passive and then taking on active roles, there really can be a marriage of the two, right? It depends on where the individual wants to be involved. That be accurate?
Exactly. Okay. And just because the strategy is the passive approach to investing doesn't mean that I spend most of my time sitting in Mexico drinking Mai Tais. I mean, I probably worked 65 hours this week already and it's Wednesday, but what I've done is built a business around that investment vehicle because I think on a risk adjusted basis, just so compelling.
So this is fantastic. So you mentioned you mentioned tactics, and I know that you have a lot of thoughts on not just tactics, but strategy. I would love for you to help us understand how these two play together as you are looking to drive positive outcomes.
Yeah, well, I'd say that from a big picture perspective, these conversations, a 30-minute conversation, for example, my goal is to give you a framework that you can use for yourself because it's very difficult for me to give you the entire playbook. So the lens through which I view this space can be simplified if reverse engineered several times. I'll give you an example. Debt financing is one of the most important, critical, and yet completely under-discussed topics when it comes to investing. It is such a clear way to view who you're dealing with, the likelihood of loss of principal, the likelihood of the property being cash flow positive, and most of the things that you're most concerned with when it comes to potentially losing money. So when I look at deals, especially right now, the first thing that I want to look at, as long as we've gone through the operator, and that's obviously the most important, but I'm talking about things that most people aren't thinking about typically. So when it comes to that, the debt financing should be paramount to your entire due diligence process. So the debt service coverage ratio, how much can a property lose occupancy before they're going to have a problem making those mortgage payments? This can be really important in something like senior living, for example, which I'm a huge proponent of, where the assets typically are 50 to 100 beds. But if 10 people pass away, you can start to have problems. Unlike multifamily, the expense ratio in senior living is typically 70%. 70% of your income goes to pay off expenses. So if you have a 90% occupied property, but 10 people pass away, you need to be very focused on getting new tenants in there, or you're going to have a trouble if another 10 people pass away. So that's just one example. But the reason this is timely is that there's so much investor interest in the senior living space, and for good reason. The demographics are really very compelling in the US and otherwise. But this issue with coronavirus can create that situation where 10 people pass away in quick succession. So, just one thing to think about. I mean, as you know, I try to get into as much detail as possible. So rather than give a broad explanation of my strategies overall, I'll give you one tool, which is really focused on debt financing, and it'll paint a clear picture.
Okay. Fantastic. So having that clear focus on debt financing and in providing that clearer picture, and I know you like detail. So there is one place in particular. You talked about risk adjusted return. That's something that I would like to get your take on what that means, because it's something that I think a lot of people talk about. But before you do that, I know that you are a master in the area of due diligence. And so lots of people, you just started talking about it, but lots of very busy professionals that are looking to, have their capital work with someone else, but they think due diligence is for the person that's looking at the operator. So can you help us understand due diligence if you're someone who's looking to work with a syndicator or someone who is aggregating capital? What does that due diligence process from the people that have been most successful as passive investors look like?
So from a big picture perspective, I think that you should do what I'm about to kind of outline on a proportional basis based on your investment amount. So if you have $50,000 to invest, I would suggest taking as much time as you need to feel comfortable. Don't ever move forward unless you feel comfortable. But in terms of actually talking to the operator, I would say you probably have 1 to 2 hours before that operator may decide that there's other ways to get $50,000. And this is not something I take lightly, because I don't want you to listen to this podcast, get all these tools, and then have it make it more challenging for you to invest. I want to give you tools so that you can invest. So that's just the first thing I'd mention. So we have a due diligence process that has 7 stages. That starts with the most important. That is the sponsor. We work from the sponsor all the way to the legal documents. And sorry to the attorneys out there, I know the legal documents should be the most important, but the truth is the legal documents only come into play if something truly goes wrong. So they're on the list of 7, but you just need to focus on the team before you actually focus on anything else. So the sponsor is number 1. The property manager is number 2. The underwriting, as far as the property's previous performance and the future projections, and one like hack or template I like to use there is comparing the previous 12 months financials to the first year financials and seeing what are the key differentiating factors that are actually creating returns here. Why is the property going from 50% operating expense ratio to 43% operating expense ratio in the projections of year 1? Now, when you start to ask those questions, you can get some reasonable answers. It could be perfectly reasonable that a property can go from 50% to 43%, but you want to know how the operator is justifying that. So all the question that I'm going to ask and every other stage after that is just about reading between the lines to see the level of sophistication of the operator, how seriously they're taking the due diligence process, and how much they're focused on principal protection. So the next stage is the loan, the lending and the financing. I think it doesn't get talked about enough. Then the market itself, the property specific due diligence. And this is things like the number of units, where the asset is physically located, how visible the asset is from the street, and how many cars are driving by it, those types of things. And then the legal documents. I think I gave you 7 there. So those are from memory. So, okay. But that's the process in general.
Okay, fantastic. So due diligence, everything from the sponsor to the legal documentation, and you've given us all the steps in between, and you've said it twice already, Hunter. And we are going to get to the risk-adjusted return, I promise. But you said it doesn't get talked about enough, and you're talking about the debt, right? And so you mentioned it before. In the first response, and you just mentioned it again. So I'm just curious, right? Because someone, they may hear what you're saying, but they're not really understanding, well, Hunter's saying this, so this must be really important, but I'm just not clear on why he's actually making reference to the debt again. So maybe if you can help us understand that as well.
Yeah. Okay. Well, first of all, I really like the way you asked that question, because that is not, like I said, I'm not trying to be just the guy that knows something. I want to be the person that helps people, right? So if it's not easily communicated, it's useless. So when it comes to debt, like with any of this stuff, the level at which you go, the deeper you go, it should be proportional based on your investment amount. So if you really want to figure everything out about the debt, I would block 30 minutes and just stream of conscious, come up with a bunch of questions without even listening to any more of this podcast. Just come up with a bunch of questions about the debt piece of a deal, and you'll come to some interesting realizations. So if you really sit and think for 30 minutes, what could be the most important things about any piece of a debt financing, and how could this negatively impact my deal? And is it worth to incur that debt? You'll probably come up with stuff that I haven't thought about, but I'll give you a couple of examples. In real estate, it's very common to have the first year or 2 be interest only on those payments. So the payments are reduced because you're not actually paying the loan down during those first 1 or 2 years. Now, what this does is that the payments are smaller. Therefore, the debt service coverage ratio is more favorable because the payments are smaller. That means it's more conservative. You're not needing to spend as much on debt every single year. And this makes the cash flow higher. So there's several different things in that little paragraph that I just said that are noteworthy. Number 1, you're not paying the loan off during those years, meaning that the loan to value is not decreasing like it normally would. Number 2, the debt service coverage ratio is more conservative. Number 3, the cash flow is going to be higher. So if you go into potentially invest to 2 deals, and one has a 1-year interest only period and the other has a 5-year interest only period, you may, without contemplating the significant differences between those two, you may think that the 5-year interest only deal is better because the cash flow is going to be higher. But it could be the case that if they both started with the same loan to value, the 5-year interest only period loan would be far more aggressive because you're not padding that equity position as you're paying it down. Now, as you know, I like to go into details, so I'll add one extra layer there. When I, probably 5 years ago, I would say that anything longer than 2 years of interest only was too aggressive for me. But especially late in the cycle, I found a lot of very savvy investors that do basically what's called pre-amortization. Rather than starting with a 70% loan to value and a 1-year interest only period, they may start with a 60% loan to value and do all interest only. And that is actually a very conservative loan because you're starting at a much lower loan to value. There's much less leverage and the payments are much, much smaller during, let's say, a 5 or even a 7-year term. So those are just a couple things to think about. Then just to add to that, so that's kind of the pragmatic, practical approach where if you read a bunch of real estate books, you're going to learn about those key metrics. But what's probably not mentioned in real estate books, a lot of things that matter. Who are these lenders? Who are the people? Have you worked with them before? What's the relationship that they have with the sponsor? Because what I have found in this industry is if you know what you're doing generally, what really matters is who is your best friend when things go wrong, right? Like assuming you kind of know what you're doing. If something goes wrong, who's going to be able to solve that problem? And just to add to that, I have found that the more prime markets, the more prime asset classes you invest in, the more friends you have. So if you've got a really tertiary mobile home park that's only 30 units, 45 minutes outside of Greensboro, North Carolina, you don't have many friends. You may get a great deal, but the question is, who can you sell that deal to? Now, if you've got 20 minutes outside of Austin, 200-unit B-class apartment, all of a sudden you got a ton of friends. You got a ton of lenders, you got a ton of buyers, you got a ton of sellers, and problems can be solved much easier. So hopefully that helps.
Absolutely helps. And I love the last portion that you talked about, because that is really about, it's focusing, and I know you're a big proponent of this, is really on who, not necessarily how, right? In being able to decipher between the two and ultimately being able to have the most appropriate options.
Yeah, so, exactly right.
So fantastic. So there's another concept that I know that you that you like to discuss as well. And you started talking about a little bit before, but there's a concept of being able to have more control in terms of the investment that you have versus having diversification. And maybe you could tell us a little bit about your philosophy there to once again paint a picture for someone that's thinking about, okay, well, yeah, I want more control or diversification, and where should I be thinking about that?
Yeah. So, I mean, first of all, I'd say that a long time ago, I decided that I wasn't going to try to convince anyone to invest with me. I think I did what most people do when they get in this industry. They figure out these cool investments. They go, oh my gosh, all my really logical friends are going to be so excited that they can invest in real estate. I'm going to go out, give them this presentation, and they're going to start investing. But that's not what happens. And it's not because you're not a good salesman. It's because what you're trying to do is basically elicit a pseudo-religious experience over a 30-minute discussion. So what you and I have done is said, we're not going to chase anyone around. We're going to have them chase us by creating a platform that attracts people that think like us already. And perhaps we can change some nuances of their discussion based on the conversations we have, which, by the way, can make you have a much better life than kind of smacking your head against the wall trying to figure out why no one trusts you. So actually, I forgot. Can you remind me what the question was? I wanted to make sure I addressed it.
Yeah. Just making sure that we help people understand with the control, your thought on control versus diversification.
Right. Yeah. Thanks for the reminder. So certain personality types, they're not going to be a good fit for the passive approach to investing because it is necessarily a limited piece of the deal. You are limiting your liability to your investment amount, but that limited liability comes because you do not have decision-making control, right? There's an important legal distinction there where if something goes wrong at the property level, because you are not the one making decisions on how to resolve those matters, you are not exposed to the liability typically associated with owning real estate directly. Now, I kind of segued into why I'm such a big proponent of the passive approach to investing, because if you can remove those risks and still get even remotely similar returns, it's just very clear. But from my perspective, in the world of economics, it is critical to have a market advantage if you're going to be successful. You must be hyper-focused to have a market advantage. This is where you get things like specialization and economies of scale and all the million things that go into doing something as simple as making a pencil, which is an example that Milton Friedman made famous. If you are not familiar with that, just Google around and, I Pencil is the name of a quick poem where he talks about how all the people in all the world and all the religions have to go into something making as simple as a pencil. And it's really, really compelling. But what's antithetic to financial planning is overallocation specialization. So you're met at an interesting crossroads. I need to be best in class at something, but if I'm only focused on self-storage in Southeast Florida, my whole net worth is going to be tied up in self-storage in Southeast Florida. So I don't want any operators to know this, but as a passive investor, I find it very compelling to identify that operator in Southeast Florida and say, here's 10% of my portfolio. I love this investment thesis, but at the same time, I want to do mobile home parks in Colorado as well. So then my job is to go out and find that operator in Colorado, and I can intelligently participate in all stages of the cycle. And as the ebbs and flows of things change, we can still play the game effectively. And playing the game is what it's all about. I don't want to generate a 30% return for 1 year. I want to generate a 13% return for 50 years. And it makes a huge, huge difference if you can do that.
I love that. And that was a great example of helping us understand the control and diversification point of you. And you also talked about it, and I mentioned it in the very beginning. And I'm always interested in when you have very successful people like yourself here, Hunter, to share about the whole premise here is like investing beyond your backyard, right? And you've just give us an example. And so many times we're taught, invest where you're right close by. You can go see your property. And, I'm thousands of kilometers, miles away, right? And I would love for you to share with others, like, why have you decided that, look, it makes sense for me in your investment thesis and philosophy to go beyond your backyard?
So, going back to your comment about who, not how, I was very fortunate to be associated with those types of very savvy investors that were pursuing advanced strategies early on. And so I was able to leapfrog a lot of those strategies that most people start out with. And I totally understand when most people think of real estate, maybe not those listening to this podcast, but most people think of real estate, they know their uncle that bought a rental and is making $1,000 a month. And they're thinking, wow, that's $1,000 a month more than I'm making. This is how I'm going to participate in the space. But if you have an uncle that made $10 million buying commercial properties, maybe that uncle is worth listening to as well. And when you compare the two, I'm sure you found on the show, you don't find many uncles that made $10 million in commercial and decide to do $1,000 a month rentals going forward. And so, the data is pretty compelling from my perspective.
Okay. Love that.
By the way, I don't have an uncle that made $10 million flipping commercial proproperties.
I was going to ask that question. You could read my mind. And so there's another thing that you also talk about. You talked about some competitive advantages earlier. And I think you talked about debt as well that many people don't talk about. And when you're looking to also you want your capital to work more. You talked about the 13%, but consistently for a number of years. And when you're looking at working with others, people don't like to talk about the administrative part, the reporting part, because it's not really cool. But I would love to know what your take is on, and maybe it goes into some of the due diligence that you were talking about before. Like, where does the whole administration, understanding and reporting and control, where should that be on someone's philosophy or someone's radar as they're looking to team with other people?
So from my perspective, as a passive investor, I don't want to burn relationships with operators due to requiring more than I agreed that they would report to me going into the deal. Now, if something goes wrong, I expect a higher level of transparency and a higher level of reporting and potentially webinars and group calls to be able to resolve these matters. So we've done 30 deals with ASIM Capital. You're going to have things go wrong. We haven't had any catastrophic issues, but we have had weird things like there's a hurricane and also an elevator breaks, and cumulatively that can be $300,000 worth of damage before the insurance starts to pay out. Those are tough calls to make, and I've had to make those calls. As an owner, I would say that bad news does not age well. And so to ramp up transparency, to ramp up communication when things are more challenging, you're being far more proactive and it puts you in a far better position. We're living through a very interesting time. And I'll give an example. If you have a significant amount of your business or investor business in the retail sector, this is wildly ahistoric. It was not in your underwriting assumption. You may have underwritten a 20% reduction in sales, but you didn't underwrite a stop, a zero, a goose egg. And that is very, very odd. Now, investors may be sympathetic to that. It's not just you. They know what's going on in the media. They understand what's going on from the government lockdowns, et cetera. But it's important to get out in front of that and increase the communication. So when things are going well, the quarterly reports should be all that passive investors need. But when things are challenging or if there's any kind of distress in the marketplace, it's important to over communicate. And I'll give you an example. I wrote an article. If you Google how will COVID impact the major real estate asset classes and ASYM Capital, you'll find an article I wrote very early on, I believe it was March, where I kind of outlined each of the asset classes that we're looking at, the potential challenges there, and where the potential opportunity may be. And we were talking offline, as someone who creates content, but also people are entrusting us with our capital. It's really important to be leaders in this space and not to hide from these challenging situations.
Completely agree, and definitely don't hide. But Hunter, can you do us a favor? Could you repeat that article? Because I really would love for the audience to go to the ASIM Capital website and look that article up again. I didn't get it down correctly.
Yeah,
but I think it's important.
Yeah, sure. So if you go to asimcapital.com, asymcapital.com, click resources, and then click articles, it's the most recent article. It will be one of the most recent articles that we've written. And it's how will COVID impact the major real estate asset classes? And I talk about some of the opportunities that will likely be presented. And because of the government actions, these opportunities have not really taken place yet. The government action has created the situation. We have really high unemployment data and also really high collections data that will likely not last. So I think the distressed debt space, for example, is going to be hit quite hard and could create an opportunity for pricing arbitrage. I think the retail sector, the challenge with that one is that you do have distress there in a meaningful manner, but lenders are so skeptical of the asset class that there's not a lot of transaction volume. So the opportunity for retail isn't quite started yet, but you could see over the next 2 years that could be very compelling if you're willing to entertain it.
Okay, fantastic. So we've just given a resource, and we're going to come back to that later on in our conversation. But thought it was a great way to have our audience head over to see some of the many different resources that you have available. I know that I personally learn a lot from the things that you put out as well, Hunter. So I do want to come back to something that I've alluded to twice already. And it's this whole concept, and I know you do a great job of helping to simplify this concept, because we hear it many, many times as we continue to do more and more passive investing, or we may be looking to get into more of an active role. But it's this whole concept of risk-adjusted return. Like this, there are a number of different ways that you can look at it. I really would love for you to share with our audience today, Hunter, when you talk about risk-adjusted return, what does that mean? And maybe you can give us an example, please.
So, yeah, I do have a good example. I think that will be very straightforward to understand. So the name of my company is ASIM Capital, and it's short for asymmetric. And yes, we try to be cool and say, oh, how do you say it? So it causes some little confusion in the marketplace, because that's fine. But that's what it's short for, ASIM Capital. And it's because all of your decisions are probabilistic in nature and should be therefore made on a risk-adjusted basis. Now, even within that paradigm, there's some places in which we're not going to entertain, regardless of how compelling it may seem on a risk-adjusted basis. As an example, we don't invest in development. So even if you present to me a 60% IRR and a very high likelihood of achieving that IRR in a development deal, we would not entertain it because it's outside of our paradigm. But within the paradigm, it's really important to analyze risk and ensure that the investments you're making are disproportional to the amount of risk that you're incurring. So as an example, we just did an ATM deal that I am very, very excited about. And before I even go into this, I know probably half your listeners are going, oh, ATM, has he never heard of PayPal? And that's actually a really important point. It doesn't apply so much to this particular model, but the important point there is that anytime you can look at something, a big picture investment thesis, that 40% or so of the smart investors in the room will turn off immediately, you're usually in a position to generate years of quality returns before the market figures it out. And I'll explain the thesis here really quickly. The ATM business is, at least the demographics that we're catering to, in the United States, the unbanked and underbanked are the entirety of the client base. And that is a very big demographic. That's 25 million people that either do not have a bank account or do not use a bank account meaningfully. And as investors, we need to measure headwinds versus tailwinds. So yes, headwinds exist to the industry, of course. There's PayPal, there's Venmo, there's credit cards, et cetera. But all of those apps and vehicles require a bank account. So that headwind exists. It could be the case that there's some new technology that comes out that doesn't require a bank account. Crypto is a good example. But on the other side of this is the tailwinds. And here's what I see in the tailwinds. I see a mountain of banking regulatory environment that is completely unovercomable, especially since 2010 with the Jobs Act, with Dodd-Frank. I don't see that coming anywhere soon. I think a lot of smart investors agree with me that the banking regulatory environment is not going to go less regulated in the United States anytime soon. Simultaneously, the interest rate environment is, from my perspective, we're entering and we're currently in a perpetually low, multi-decade long, ultra low interest rate environment due to money printing, not only in the United States, but on a global basis as well. Mm-hmm. And so what happened in the banking sector is that banks no longer make money from lending money because interest rates are so low. So they completely changed their model to where previously Bank of America, for example, 90% of their revenue was generated by lending activities. That number has gone from 90% to 50%. And what's made up the gap? Fees, particularly low balance fees, bank account maintenance fees, late fees, lack of payment fees, et cetera. So if you have a $600 net worth, which tens of millions of people do in the United States, you do not have a bank account. At least it's not economically viable to do so. So I'm seeing this massive tailwind, and the opportunity itself is unlevered and does produce that double-digit teen IRR. So like on a risk-adjusted basis, I'm willing to incur that risk in exchange for the lack of leverage, in exchange for the uncertainty around the ATM business and the technology due to the ultra high cash flow and the really compelling IRR.
Thank you very much for that example, and it is something that we have talked about here, the ATM space. And
oh, really? Cool.
And yes, so we're educated in that area, and so you've just helped to reinforce the point with a fantastic example around risk-adjusted return. So thank you for that. And the thing that I just want us to understand once again, what you're talking about is it all starts with your own individual philosophy or paradigm, right? It has to fit in that paradigm, because whether you gave a great example, if it doesn't fit in your paradigm, but it's a 60% return IRR, well, you know what? It's probably not a good place for you to be no matter what, because it doesn't fit your philosophy. So I love that.
Correct. It's a business decision.
Yeah, absolutely. Absolutely love that. So, Hunter, I just want to keep asking you questions and have you educate us forever. At the same time, you're an extremely productive individual, and I know that you pretty soon need to be doing some other things. So what I'd love to be able to do at this point, Hunter, is going to our going long final three. But the thing is, I never ask the going long final three unless you tell me that you're ready for me to ask you. So are you ready?
Let's do it.
All right, perfect. So we started out on your side of the pond. And since I'm over here in Barcelona, I always want to know, what is your favorite European city, either that you visited or are still on your bucket list to visit?
I've got to go Lisbon. I heard so many good
Oh.
things about it, and I went there about a year and a half ago, and man, the food, the culture, the tourist attractions are just unparalleled. So it's one of those ones that I'm sure a lot of people are starting to hear more and more about, but there's a reason for it. Go check it out.
Yeah, it's definitely an awesome place. So another vote for Lisbon. So fantastic. Second question, Hunter, all of the very successful people that I know have tended to only make one mistake. Well, hang on a second. They've made multiple mistakes, issues, learning opportunities that they've had. And more than those kind of experiences, I'd really love for you to share, like, what is one lesson that you would pay forward to someone else so that they may not make exactly the same mistake per se?
Okay, so this is counterintuitive, but again, I try to provide content that you would likely not get otherwise. And I love the focus on cash flow. That's how I built my business. The name of my podcast is Cashflow Connections for good reason, because the predictability of outcome. But early in my career, I think I focused too much on cap rates and cash flow to my detriment. And here's what I mean by that. Going back to the conversation about tertiary markets, there is something to be said about the viability and the tradability and the liquidity of those slightly more prime markets that you know are going to be able to withstand any kind of recession. You can get caught investing 45 minutes outside of Greensboro, like I mentioned, which I've done, by the way, and made great returns there. But you incur a risk that that market will dry up, that other institutional investors, for example, would not be interested in entertaining a purchase there, regardless of what the returns or regardless of the cap rate. What tends to happen is that as the market gets later and later in terms of the market cycle, people tend to move further and further away from prime markets because they're chasing yield. But what happens is that snapback takes place when the market corrects. And so you can have those really tertiary markets. Not that Greensboro is a tertiary, super tertiary market, but you can understand what I'm getting at here. Yep. The demand for that product can shift quickly. If you're in Austin is the great example because there's so much investor interest there. That's going to be around in 5 years and 10 years and 15 years. Furthermore, if you can add $100,000 of NOI to a 5 cap, it's much more consequential than adding $100,000 of NOI to a 10 cap. And so those are some important things that I would think about.
Okay, fantastic. So really appreciate you helping us to understand the lesson to be able to pay forward and think about. And I just want to recap before I ask you the very last question. I think it would be great for our audience, especially for those of you that are interested in understanding more about raising capital. Just want to say it again. Hunter is a best-selling author with Raising Capital for Real Estate: How to Attract Investors, Establish Credibility, and Fund Deals. So we're going to include that in the show notes because I think it's something that everyone should go out and pick up to be able to learn, especially for those looking to raise capital. And at the same time, Hunter, I would love for you to tell us a book that you would recommend to the Going Long audience.
Yeah. So one of the inspirations for the way in which I wrote the book was Double Double by Cameron Herold. From my perspective, he took a $25,000 coaching program about how to double the size of your business in 3 years or less and just wrote it down and gave it away for $15. And so that inspired me to write the book the way I wrote it. And so I think Double Double is a great example of someone who his intention was, if you can change 100,000 people's lives, you can make millions of dollars. Right. And so the easiest way to do that is to have the content you create just be so out of this world in terms of the competition that the book's going to catch viral status to some degree with the people that are interested in actually taking action. And that's the best client base to have.
Okay, fantastic. So Double Double, we will include that in the show notes as well. And listen, Hunter, there's so much goodness that you have shared with us, everything from the very beginning to helping us understand, the active versus passive. You've helped to walk us through and understand the importance of tactics and strategies. You've been able to give us your 7-step process for following through to due diligence. You've helped to give us a wonderful example and real concrete example around what is risk-adjusted return as it relates to looking at different types of opportunities. You talked about the importance as well of reporting and administration and being able to do something or help as a part that is something that every investor that is passive should be looking for. So you've also talked to us a bit about ASIM Capital. And, there's just, you've just, once again, you've shared so much in typical Hunter Thompson fashion. And, because of that, I'm sure that there are so many people that are like, oh my gosh, I need to find out more about Hunter, what he's doing, cash flow connections, all that kind of stuff. So what is the best way, Hunter, for people to get in touch with you and with your team?
So if you're interested in investing passively, we have our private equity company, which is asymcapital.com. We also have two events that are coming up that may be interesting to your audience, depending on a couple things. So as you mentioned, I wrote a book about raising money, and we have a summit that's about that particular topic. So it's not about real estate. It's not about passive versus active. It's a very specific summit where all of the speakers are going to talk about their one strategy of how to raise $5 million in 30 days. And it's a free summit, and you can watch it from home, and you can learn more about that at 5millionin30days.com. And that is the two numbers there. 5 and 30 are both the numbers. Now, if you're more on the passive or investor side of things, we have a conference coming up called the Intelligent Investors Real Estate Conference. And that is IIREC2021.com. And both of those have some of the most well-known, well-respected capital raisers and investors in the United States and otherwise, by the way. And so hope to see you there.
Fantastic. So you've given us a wealth of resources, but I want to just come back on the last two specifically, IIREC2021.com for the Intelligent Investor Conference. And then also, and this is, listen, for everyone that is here, that is listening, that is watching us, I want you to actually take action, right? Hunter's made it really easy. He's packed it with action. He's packed it with a wonderful resource, and he's made it free. So 5millionin30days.com. It's the number 5 and the number 30. And so definitely want everybody that is part of the Going Long audience that is here, that is listening, that is watching, to go there now, because you're going to actually, you want to make sure that you catch it right now. So listen, Hunter, it's been fantastic, man. I really want to thank you from the bottom of my heart for taking the time to invest with me, with the Going Long audience, because it's been absolutely fantastic. So thank you very much.
Happy to do it. Thanks again.
All right. Awesome. And listen, for the entire Going Long audience, once again, Hunter's been fantastic. He shared so much with us, and he's really helped you to understand and to learn much more about this space. And so listen, you can make a positive impact on so many other lives. So at least share this episode with 2 to 3 other people. That way you can be that person that's helping to raise the game of those people that are around you. And you're doing such a wonderful benefit to others. And at the same time, what we'd really love to understand, what are the things that you liked? What are the things that you'd like to know more about? And so feel free to go ahead and leave your written comments, your reviews. If you want to leave a 5-star, we'll also take those. And listen, I am really looking forward to welcoming you back on the very next episode. Until then, go out and make it a great day.
Wow, don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.